All right, continuing on in our financial accounting series, we're up to lesson 6, inventory and cost of goods sold. Working our way down the income statement and the balance sheet. The overview of this section, we're going to define inventory and discuss its importance. We're going to define the 3 main inventory costing methods and calculate the impact of those methods on financial statements, and then get into some other topics related to inventory valuation and the choice of method. So first, to define inventory and discuss its importance. So cost of goods sold and inventory are huge numbers for many companies. This is Walmart right here. And if we look at this financial information, this is for their most recent year ended January 31st, 2024. They use a fiscal year end January 31st because they're retailers, so they have a lot of returns going on over the holiday season. Now, if we look at that, we can see that their inventories are $54 billion. So just a huge amount, one of the biggest in the world. And so how they account for those inventories is very important and can have big impacts not only on the balance sheet, but correspondingly on the income statement. We look at Walmart, their cost of sales for the most recent year. Looks like they had $648 billion worth of revenues. Their cost of sales was $490 billion. So these are huge amounts which will impact their financial performance. Now these, I wanted to just look at how this might differ in some different industries. So what I did is I grabbed the Fortune 500 list and found the 10 biggest companies out there. And we have their revenues that are listed right there. So there's Walmart with $648 billion, and they're roughly $55 billion of inventory, so 8.5% of their sales. And I wanted to look at it for the other 10 companies, the 10 largest companies in America, just to kind of see which type of companies have more and less in inventory. So Amazon, $33 billion. They got a lot of products, right? So a little under 6% of their revenues. Apple, only $6.3 billion of inventory. Only have 1.6% of their revenues. United Health Group, big healthcare company. They are services. They don't have inventories. Berkshire Hathaway, that's Warren Buffett's company. $364 billion of revenues. A lot. Basically, Berkshire Hathaway owns investments in other companies, and they don't themselves have inventory. The companies that they own have inventory. CVS Health, healthcare. You think of all the pharmacies out there. CVS, you walk in there, they've got not only the pharmaceuticals that they're going to resell, but all their shelves are stocked with stuff as well. That's $18 billion worth of inventory. ExxonMobil, $25 billion worth of their oil, basically sitting there looking for resale. Google, service-based organization, does not have any inventory. McKesson in healthcare, $21 billion of inventory, 7.6% of its revenues. And then Cencora, also in healthcare, $17 billion worth of inventory, close to 7% of its revenues. So Walmart has the biggest number overall, but we're seeing several of those companies have inventories which are more than 5% of their revenues. All right, definitions here. So what is inventory? Goods or products that a company owns and then it's holding them for resale. So merchandisers, what they are going to do with their inventory, they're buying finished products from someone else and then reselling it. When I think of examples, of their merchandise inventory, I am thinking of like your Walmarts and your Targets and your Costco's, your Best Buys. Companies like that are your merchandisers, right? A lot of your retailers is what you're thinking of. And manufacturers are those who produce goods. So the examples of companies who have raw materials, work in process, companies like that, you're going to have any manufacturer. So Apple, one of the biggest manufacturers in the world of phones. You got all your car companies. You've got Toyota and Honda and Ford and GM. You've got airlines with With Boeing, you've got just any product that you see, right? Clothing manufacturers and computer manufacturers and just everyone you see that way. So they have the manufacturers. They have raw materials work in process, which is raw materials process. They've got direct labor. They've got factory overhead. Those are different types of inventories that they have. In financial accounting, in this series, we're going to be focusing on the merchandisers. It's usually the second accounting course, managerial accounting, where you dig into more of the manufacturing companies. So finished goods also is something that manufacturers have. So review question number 1: what is a typical type of inventory of a retailer? Take a peek at this one. Do you know the answer? It's not finished goods. All right, those are finished products held for sale by a manufacturer. It's not raw materials. That's the stuff that the manufacturers buy and they're gonna work on, which is work in process. It's not that either. It's a retailer is going to have merchandise inventory. They're buying it and they're holding it for resale. So now we're going to dig in, and this is really the crux of this lesson here, the 3 main inventory costing methods, and calculate the impact of these methods on the financial statements. So first off, inventory, when it is purchased, you are generally going to debit inventory, and then you are going to credit cash or accounts payable. Some companies, they will debit what's called a purchases account, which will end up being a part of inventory. I simplistically will just refer to this as debiting inventory. So debit inventory, credit cash, that is going to be, what they will use to when they purchase the inventory. Now, when the inventory is sold, when the product is sold, there's going to be a debit to cost of goods sold and a credit to inventory. All right, so the inventory comes when you purchase it. It goes away when you sell it. So it ends up to be cost of goods sold at that point in time. Now, inventory systems, perpetual inventory levels are adjusted each time that a sale is made. So most established, companies, small, medium size, big size, once they get rolling, they are going to use a perpetual system. So at any point in time, they know how much inventory they have. They still have to count their inventory at least once per year to compare what their systems show that they have versus what they actually have. Sometimes they could have shipped the wrong amounts. They could have had some stuff that was stolen or scrapped or what have you. So they need to count it to kind of true up their inventory levels at the end of each year. And then the periodic inventory system means that they're not going to track it as it's being sold. So they just basically have it sitting in a pile. And then they just sell it. They just sell their inventory, and they really don't keep track of how much inventory they have until the end of oftentimes a year when they count it, and they will just determine it at that point in time. And that's when inventory counts are going to be very critical. Otherwise, they'd never know how much they have. So, in an optimal world, you use a perpetual system, but some very small businesses just don't do it. It just doesn't make sense to them, or they can't afford to do it either time or money. Now, the inventory and cost of goods formula, we're going to take beginning inventory, and this is a critical formula here, add in purchases, and that's going to give us what we call goods available for sale. We're going to subtract off ending inventory, and that's going to give us cost of goods sold. So this is definitely a formula that you need to commit to memory and just need to understand. Now, it seems really straightforward, but ending inventory can be computed many different ways and is therefore complex. So the inventory methods. GAAP is going to require that a company choose an inventory valuation or costing method. So GAAP says you can choose FIFO, LIFO, or weighted average. Those are the three most common options out there. They also say you can choose specific identification if it makes sense in your industry. That's more of a unique one, and we'll just look at that at the end. But let's take a look at base facts, and then we'll apply FIFO, LIFO, and weighted average to these base facts. Let's say you've got a company that at the beginning of a period has 100 units, which it paid $20 for, so it had $2,000 of beginning inventory at the start of the period. It then purchased 110 units for $21 a piece, had another purchase of 120 units for $22 a piece. So in total, it has 330 units for $6,950 of total in dollars. Now, let's say that this company sold 200 units. It knows that it has 130 units in ending inventory, but we don't know until we compute it what the dollar amount is because we don't know which of the units that we sold. We know we had 330 units and we sold 200. So we know we have 130 left. We don't know which ones we sold. Now, you don't actually have to track the specific ones that you sell. You just choose a method to account for it. First in, first out is going to be the most common one that is chosen. And so this right here, what I just kind of flashed up on the screen, these are the base facts that I just showed you on the previous slide. So this slide right here, goods available for sale of $330 in dollars is $69.50. That is this again right here. But then what we are going to do is try to figure out in our ending inventory, all right, because they sold 200 units, right? Previous slide says we sold 200 units, so they have 130 units in ending inventory. What is the cost of those? Well, first in, first out means basically that the stuff in the beginning we sold and then, part of the next purchase that we sold. Normally, what a company does, however, if it's first in and first out, is it will just count how many units are in ending inventory starting at the back. So it's kind of like the last stuff that we purchased is the stuff sitting in ending inventory. And that's because you sell a lot more than usually is sitting in ending inventory. So if you go to what's in inventory first, it'll be a lot quicker calculation. Right here I just have beginning inventory and two purchases. Real world, it's going to be beginning inventory and dozens or hundreds of thousands of purchases. All right, so you just want to go to the ending inventory. So we're trying to figure out of these 130 units, what, for accounting purposes, we're going to say that they cost. So first in, first out, we're going to estimate that we sold the beginning stuff, which means that this last stuff is still in ending inventory. We have 130 units in ending inventory. Must be these 120 at $22 a piece. And then it must be 10 units from purchase number 1 at $21 a piece. So that's how we get to 130 units of ending inventory. And when we multiply it across and add it up, we're going to say that it cost us $2,850. All right. So we sold 200 units. Remember the previous slide, if we go back to it, we sold 200. We have 130 in ending inventory. What is the value of that? Okay, so we sold all the stuff at the beginning. We sold 100 from purchase 1. So 10 of purchase 1 is in ending inventory. All of purchase 2 is in ending inventory. So what we do is we compute ending inventory and then take goods available for sale minus ending inventory, and that gives us our cost of goods sold. We sold 200 units at $4,100. That's just a subtraction of the $69.50 minus the $28.50. All right, last in, first out. So here's your same structure, but what this means is the stuff that we sold, the 200 units that we sold, are first coming from purchase 2, and then some from purchase 1. The stuff in inventory is starting with the beginning and then some stuff from purchase 1. So ending inventory is this because it's last in, first out. That means that the accounting treatment is saying that the first stuff is still in ending inventory. So this could be the 100 units that we started with at $20 a unit, and then 30 units from purchase 1 at $21 a unit. We multiply those across, we add them up, we get that those 130 units in ending inventory cost $2,630. That is what our estimate is. So that we then subtract goods available for sale of $69.50 minus the $2,630 to get our 200 units sold cost $43.20. All right. We'll go to the third method and then we'll talk about and compare all these. The third method, in my opinion, is the easiest because if you go back to that FIFO and LIFO, I mean, I went through that, but it takes some work to get used to those two. All right, it's not like I just explain it once and it makes perfect sense. You gotta work through it. Weighted average to me is easier because you bring up the same model here, and then all you do is you take the $69.50, you divide it by the $330. And that's $21 and like 0.0606 cents. And then you multiply that by the ending inventory in units of 130 to get ending inventory of 2738, and then cost of goods sold, those 200 units cost $4,212, which we could get either by just multiplying that by the same 21.0606 average cost, or the 6950 minus the 2738. Well, in summary, all right, FIFO, LIFO, and weighted average each had $8,000 of sales. FIFO had 4,100 of COGS, LIFO 4,320. Weighted average is always going to be in the middle, not like exactly in the middle because it's weighted. The only time it would be exactly in the middle is if you maybe had two purchases and they were each for the same, like 50 goods at $100 and 50 goods at $150. Like those were your purchases, and then you would just kind of take the average inventory cost. But it's very rare that you ever purchase the same quantity. So that's why you need to do a weighted average. So the gross margin under FIFO, $39.50, LIFO, $36.80, weighted average, $37.88. Ending inventory from our previous three slides, $28.50, $26.30, and $27.38. Now we look at that, all right? And part of what I want to just kind of, I suppose, illustrate here is prices were increasing. If we go back right here, prices are increasing from $20 to $21 to $22. Okay, so the beginning versus purchase one versus purchase two, prices are increasing. So if prices are increasing, that's a period of inflation. Under FIFO, we're selling the old stuff, so that's going to have a lower cost of goods sold. So that's why profits are the highest under FIFO under a period of inflation, because we're selling the old stuff, which then has the lowest cost of goods sold on it. LIFO is we're selling the new stuff, and under a period of inflation, that's going to have a higher cost, and then weighted average is going to be in the middle. Now, the financial statements will look different based on which method that you choose, but this is a tough one for people. The economic value of the company is the same under each approach. Under each of these approaches, at the end of the year, you are going to have 130 units in ending inventory, and you are going to have received $8,000 of cash for selling the 200 units of inventory. You got the same amount of cash on the sale. You have the same units in ending inventory. Yes, they're carried at different amounts on your balance sheet, but those are accounting values. All right. So the inventory choice is not really a good nor bad thing. It'll make your profits look different, but it's we got to remember the economic reality. It's the same company. We're assuming these products are the same, so they have different inventory costs attached to them based on when they were purchased and what we treated as being sold. Under each approach, $8,000 of cash, 130 units of product are still on hand. So this is a tough one for people to wrap their arms around, but we just have to bring it up, and with time it'll hopefully come. Now the trends when inventory prices are rising, like we just saw, FIFO is going to have the highest ending inventory, lowest COGS, and highest gross margin. In a period of deflation, that doesn't happen too often. It can happen with technology, that some stuff starts really pricey and then comes down in price over time. But in that situation, LIFO would have the highest ending inventory and the lowest cost and the highest gross margin. But normally we're in a period of inflation, so FIFO has the highest profits. And as a result, companies tend to choose FIFO because of that more than any others. It's simple. It has the highest profits, so they just choose it and they roll with it. Specific identification. This is more likely to be used with a company that sells very specific products. Maybe it's jewelry, maybe it's a home or other sort of construction. Companies which make custom products. Accounting firms, law firms, places like that. Healthcare, where you're actually selling services that are specific and look different to different type of clients. If we say that a jeweler has 3 rings in stock and they cost the jeweler between these three rings, $2,000, $3,500, and $5,200, and they sell the ring which costs $3,500, they absolutely are going to know that it's that ring that they're selling. So they will usually use specific identification, and they will just debit cost of goods sold and credit and in inventory for that $3,500. It wouldn't make sense for the jeweler really to use FIFO, LIFO, or weighted average when these prices are so distinct and it's easy to track which one is being sold. Well, review question here. If a company begins the year with 100 units at a cost of $5 a piece and purchases 50 units at a cost of $6 a piece and then sells 10 units, what will be its cost of goods sold, assuming it uses FIFO? So if you want to test yourself on this one, you could certainly pause it and see if you could get it. All right. And in this one, what I'm going to do is skip to the correct answer, and you can just kind of see why the incorrect answers are incorrect. I tried to, envision why people might choose something different. But this is FIFO, basically. So the first goods purchased at $5 a piece are those that are treated as sold. So 10 units at $5 a piece was the purchase, $50 is cost of goods sold. All right, they began the year with 100, they purchased 50, they sold 10. I could have first computed ending inventory and then backed into cost of goods sold for this. I didn't need to. All right, it's just FIFO. It's like, because I was not trying to compute ending inventory, I was just trying to compute COGS. And it's like, well, FIFO, so it's the first stuff we purchased is the first stuff we sold. The first lot that we had was $5 a piece. We sold 10 of those, so it's $50. Well, just a couple other topics as it relates to inventory valuation and the choice of method. Public companies like to show higher profits, and in most industries you have inflation, so they are going to choose FIFO. If you do have some companies that choose LIFO. Interestingly, if a company chooses LIFO, its profits are going to be, lower early on, assuming there's a period of inflation. But oftentimes companies early on aren't making any money anyway. They're struggling, right? They have losses in the early days. So choosing LIFO early on would be an interesting strategy for a company to try to show higher. Again, it's accounting profits and not economic value, but they could do it and have a bunch of costs in the first years. Basically when they're showing losses anyway. And then in later years, they might not have as much then maybe would not have as much as far as cost of sales is concerned. But that would really just depend upon if they're growing and the numbers involved. Now, companies can choose different accounting methods for tax purposes. And in a period of inflation, companies would thus show lower profits and pay less in taxes by using LIFO for tax purposes. But if they choose LIFO for tax, they would also have to use that for books. So normally we're in a period of inflation, and so companies would want to choose FIFO for books and LIFO for tax because you like profit for books. You don't like profit for tax because then you could pay less tax. But that's where it's said, yeah, you do LIFO for you do LIFO for tax. You got to choose LIFO for books. So public companies, they need to weigh lower accounting profits versus a lower tax bill. Private companies, especially if they don't have to file GAAP financial statements with the SEC, maybe they're not trying to get a loan. Many times private companies will choose LIFO, which will actually reduce their profits. Again, it's just accounting profits. It's not economic profits. It'll reduce their accounting profits, and therefore they could pay less in tax and give them a better economic answer that way. So that might be the case with some private companies. Walmart, they actually chose in their U.S. segment to use the last in, first out method. In their international segment, they used the weighted average cost method using first in and first out. And then in their Sam Club segment, they used the weighted average cost LIFO method. So some unique methods that they're using there, a little bit more advanced. I mean, this is Walmart, right? Hundreds of billions of cost of goods sold, but they're using different approaches in the U.S. versus international versus Sam's Club. The LIFO reserve, really one final thing. So if a company uses LIFO for books, I think most companies do use FIFO for books. I don't actually have that percentage handy. But if they use LIFO, they have to disclose what's called the LIFO reserve, which basically is what would inventory have been if they used FIFO. And then cost of goods sold over history would have then been different by the amount of the LIFO reserve. So for General Mills, their inventory on their balance sheet is 1.8 billion, and they use LIFO. And down here, they go through the computation of how they get to that 1.8 billion, and their LIFO reserve is $540 million. So they're showing finished goods, raw materials, and grain under FIFO, but then illustrating how they use LIFO to change the amount of that inventory. Well, review question here. If a company buys 10 units at $20 a piece and they decrease in value during the year to $17, at what amount should they be recorded on the year-end balance sheet? And I actually realized right when I read that I actually hid a PowerPoint slide. So I'm just going to go back to where I talked about that. You're like, I don't know, Boz, we didn't even cover that, right? All right, there we go. I actually had hid the lower of cost or market slide, so I got to go back and cover that one, and then we'll go back to that review question. All right, one more topic, the lower of cost or market. If inventory has declined in value, a company may need to write down the value of the inventory, decrease it. The general principle is they should record the inventory at the cost that they purchased it at, or the net realizable value, which is the selling price less their cost to sell the inventory. So let's say that Best Buy purchases a model of TVs from Sony for $500 a piece. 1 year later, it still has 100 TVs on hand and could only sell them for $400 a piece. What this means is the net realizable value of $400 is less than what they paid of $500. So they paid $500 for something that they really could only sell for $400 right now. So that $100 decrease by the $100 of TVs that they have left on hand needs to be taken immediately as a reduction to cost of goods sales and a reduction to inventory. So that's debit COGS, credit inventory, each for 10 grand. Now, as a result, then when they sell that, when they actually sell those TVs, this isn't like a permanently bad thing. And we normally think of having to, do an adjustment like this to record additional costs as goods sold. It sounds bad, right? But now when they go to actually sell this inventory, it's at a lower value on their books because they reduce some of it right now. So they're going to have lower cost of goods sold in the future when they sell this inventory, only $400 a piece. Why they have this is you can imagine that a company like, let's say, Best Buy here is like, wow, we're going to maybe have to take a loss if we sell this inventory. Let's just not even sell it. And this would be more of an extreme example, probably not something Best Buy is going to do if it's just gone down in value by $100. But you could have some small emerging companies that paid a lot for its inventory and is basically worthless. Let's say the inventory becomes worthless, and if they sell it, they have to actually show a huge loss, huge cost of goods sold. The company might choose not to sell the inventory, not to show that loss in their financial statements, and that would mislead investors, right? So instead, what the accounting rule said, they say no, right? Even if you haven't sold the inventory, if it's declined in value, you've got to show the loss when it declines in value. So this happens to most companies a little bit, right? Because they have some inventory that gets outdated. But for most companies, this is not a material issue. So now, if I go back to review question 3, we have a shot at answering this. Again, I had somehow right-clicked on that slide and hit hide. But if a company buys 10 units at $20 a piece and they decrease in value to the year to $17, at what amount should they be reported on the year-end balance sheet? Take a moment, see if you can solve that one. What amount should they be recorded? The inventory on the balance sheet. It's not 30, that's going to be the adjusting entry. It's not the 200 that they paid for it, because it's not worth at least that amount anymore. It's not 230, We don't increase it by $30. We decrease it by $30. When they bought the inventory, they would have recorded it for $200, but now they can only record it at $170. It's worth $17 a piece for these 10 units. So $170 is what the inventory would be recorded at. $30 would be the adjusting entry they would have to make to debit COGS and credit inventory. Well, thanks for tuning into this one. We talked about inventory and how it's debited when purchased, credited when sold. COGS is debited when the inventory is sold. We talked about FIFO, LIFO, and weighted average, and how under periods of inflation, FIFO will give us the highest inventory, lowest COGS, and the highest profit. And that the choice of inventory method, it doesn't have to conform to the actual flow of goods, and it should not affect the true economic value of the company. But we have to choose something for accounting purposes. We've got to figure out what to put on our income statement and balance sheet. So that's why we had to go through these methods. That's what we got. We'll see you for the next lesson.